Hey everyone! A wave of economic data just dropped, and the US markets are reacting big time. Here's the takeaway. Consumer spending is cooling, the job market is softening, but inflation looks better than expected. Suddenly, a December rate cut is back on the table. Let's break it down, one by one. Chart decreasing. How's consumer spending holding up? Consumer spending makes up nearly 70% of the US economy. So, what's going on? In September, former President Trump's tariffs drove prices higher, while a weaker job market made Americans more cautious with their wallets. According to the Commerce Department, September retail sales grew just 0.2% month-over-month, missing expectations and slowing sharply from August's 0.6%. Many imported goods lagged across the board. Clothing, electronics, and appliances just aren't moving. As one economist put it, we're now in a K-shaped economy. Spending is largely driven by high-income households, while middle and lower-income groups are pulling back. Backhand index pointing right. Not sure what a K-shaped economy means? Check out this expert interview. Worried face. Consumer confidence takes a dive. Consumer confidence just hit a 7-month low. A November survey from the Conference Board showed growing pessimism. People are increasingly anxious about the present and future economy, especially jobs. The share of respondents who think jobs are plentiful plummeted to 6%, down from 28.6% in October. Meanwhile, nearly 18% said jobs are hard to get. Chart decreasing. Employment data looks weak. Yesterday's ADP report echoed the gloomy jobs picture. Over the past 4 weeks, the private sector shed an average of 13,500 jobs per week, way up from the previous 2,500 per week. Layoffs are accelerating fast. Bar chart. But inflation? Not so bad. Before the market opened, the Labor Department reported September PPI rose 0.3% month-over-month, matching expectations. Core PPI, excluding food and energy, increased just 0.1%, below the expected 0.2%. Yes, import tariffs pushed goods prices up 0.9%, the biggest monthly jump since February last year. But since PPI reflects production-side cost pressures, which eventually feed into CPI, the overall trend still looks manageable. Face with monocle. So what's the bottom line? Weak spending plus weak jobs plus stable-ish inflation equals glowing bets that the Fed will cut rates soon. According to the CME FedWatch tool, the market implied probability of a rate cut in 2.5 weeks has shot up to 85%. Studio microphone. What's Wall Street saying? The CIO of financial firm LNW put it bluntly. Asterisk. I've been in finance for 30 years, and I've never seen rate cut expectations swing this wildly in just a few days, from 40% to 80%. The market has become hypersensitive to this issue. Asterisk. He added that while no one can predict the future, the trend is clearly pointing toward a cut on December 10th, which could also fuel the so-called Santa Claus rally. White heavy checkmark. Subscribe for more updates like this. Stay informed with clear, timely breakdowns of what's moving the markets.